Welcome to the jungle. The stock market is a bustling, dynamic environment where fortunes can be made or lost in the blink of an eye. What is the stock market? It's a place where stocks or shares of ownership in companies are bought and sold. The stock market can seem like a scary place full of uncertainty and risk. The constant fluctuations and the sheer volume of information can be overwhelming, but don't let it be. With the right knowledge and approach, it can be a powerful tool for building wealth. Think of it as a giant flea market, where buyers and sellers come together to trade goods. In this case, the goods are pieces of companies. Companies sell pieces of themselves to raise money. These pieces, known as stocks or shares, represent a portion of ownership in the company. These pieces are called stocks or shares. When you buy a share, you are purchasing a small part of the company. When you buy these shares, you become a part owner of the company. This means you have a stake in the company's success and can benefit from its growth. The stock market is where buying and selling happens. It's a marketplace where investors can trade their shares with others. It's the ultimate game of supply and demand. Prices fluctuate based on how many people want to buy or sell a particular stock. When more people want to buy a stock, the price goes up. This is because the demand for the stock is higher than the supply. When more people want to sell, the price goes down. It's that simple. The balance between buyers and sellers determines the price. But remember, it's not a casino. While there is risk involved, investing is about making informed decisions based on research and analysis. Investing is about owning a piece of great businesses. When you invest in a company, you are betting on its future success and growth. Over time, as the company grows and becomes more profitable, the value of your shares can increase, leading to potential financial gains. It's important to have a strategy and to diversify your investments to manage risk. Don't put all your eggs in one basket. The stock market has its ups and downs, but historically, it has trended upwards over the long term. Patience and perseverance are key. With today's technology, anyone can participate in the stock market. Online platforms and tools make it easier than ever to buy and sell stocks. Whether you're saving for retirement, a child's education, or a big purchase, investing in the stock market can help you achieve your financial goals. So don't be afraid to dive in and explore the opportunities the stock market has to offer. With knowledge and careful planning, you can navigate this jungle and come out ahead. Stocks, shares, and slices of pie. Understanding the basics. Let's break it down. When you hear the term stocks, you might think of Wall Street or the stock market, but what does it really mean? Let's dive in. A stock is a tiny piece of ownership in a company. When you buy a stock, you're essentially buying a small part of that company. Think of it like a slice of a giant pie. Each slice represents a share of the company. The bigger the company, the bigger the pie. Large companies have many shares, and owning even a small piece can be significant. Each share represents a tiny slice. The more shares you own, the larger your portion of the pie. If the pie gets bigger, meaning the company does well, your slice becomes more valuable. This is because the overall value of the company increases, making each share worth more. You buy and sell these shares on a stock exchange. This is where the action happens. This is like a marketplace for stocks. Here, investors come together to trade shares. It's where buyers and sellers come together. They negotiate prices and make transactions. The price of a stock goes up and down depending on how many people want to buy or sell it. Easy peasy. The more demand there is for a stock, the higher its price will go. Conversely, if more people want to sell a stock, the price will drop. This fluctuation is driven by supply and demand. When a company performs well, more people want to buy its stock, driving up the price. News about a company's earnings, new products, or market trends can also affect stock prices. Positive news can lead to higher prices, while negative news can cause prices to fall. Today, buying and selling stocks is easier than ever. With just a few taps on your smartphone, you can trade stocks from anywhere in the world. Managing your stock portfolio involves keeping track of your investments and making informed decisions based on market conditions. Many people seek advice from financial advisors to help them navigate the complexities of the stock market and make sound investment choices. Understanding the basics of stocks and the stock market is crucial for anyone looking to invest. Education and research are key to making informed decisions. So remember, a stock is a piece of ownership in a company, and its value can change based on the company's performance and market conditions. Happy investing. Riding the bull, battling the bear. Market trends explained. You'll hear people talk about bull and bear markets. A bull market is like a charging bull. Prices are going up, everyone is optimistic and buying stocks. A bear market is the opposite. It's like a grumpy bear. Prices are going down and people are scared. Don't panic if the market takes a dip. Remember, investing is a long-term game. What goes down often comes back up. Stay informed, be patient, and don't make rash decisions based on short-term market swings. Why climb this roller coaster? The stock market can seem like a wild ride full of ups and downs, twists and turns, but there's a reason why so many people choose to invest their money here. The benefits of stock market investing are numerous and can significantly impact your financial future. So why invest in the stock market? It's not just about the thrill of the ride. It's about the potential for substantial financial growth and the opportunity to build wealth over time. It's a chance to grow your money faster than you could in a savings account. While savings accounts offer safety and stability, the returns are often minimal. In contrast, the stock market has historically provided higher returns over the long term. When you invest in a company that does well, your investment grows too. This means that as the company expands and becomes more profitable, the value of your shares increases, leading to potential capital gains. Plus, you can earn dividends. Dividends are a portion of a company's earnings distributed to shareholders, providing a steady income stream in addition to the appreciation of your stock's value. That's like getting a bonus check just for owning the stock. These dividends can be reinvested to purchase more shares, further compounding your investment growth. But remember, investing always has risks. It's important to be aware that the stock market is not a guaranteed way to make money. The stock market can be volatile. This means that prices can fluctuate widely in short periods, influenced by various factors such as economic data, political events, and market sentiment. That means prices can go up and down quickly. While this volatility can be unsettling, it also presents opportunities for savvy investors to buy low and sell high. That's why it's important to do your research and invest for the long haul. Understanding the companies you invest in and their market conditions can help you make informed decisions and mitigate risks. Don't put all your eggs in one basket. Diversify. By spreading your investments across different sectors and asset classes, you can reduce the impact of any single investment's poor performance on your overall portfolio. A well-diversified portfolio is more likely to weather market storms and provide steady growth over time. Remember, patience and discipline are key to successful investing. Ultimately, investing in the stock market can be a powerful tool for achieving financial independence and securing your future. So, while the ride may be bumpy, the potential rewards make it worth considering. Section 5. The Big Leagues Exploring Major Stock Exchanges. There are stock exchanges all over the world. The New York Stock Exchange, or NYSE, is like the Yankee Stadium of stock markets. It's one of the oldest and largest in the world. The Nasdaq is another big one. It's known for technology companies. Each exchange has its own rules and listing requirements. Think of them like different leagues in a sport. The NYSE is like the major leagues, while smaller exchanges are like the minor leagues. But don't worry too much about this as a beginner. Focus on understanding the basics first. Section 6. Baby Steps on Wall Street, a beginner's guide to investing. Ready to jump in? The first step is to open a brokerage account. This is like a bank account for your investments. You can open one online in minutes. Next, decide how much you want to invest. Start small and gradually increase your investments over time. Now comes the fun part. Choosing your investments. Don't get overwhelmed. Start by researching companies you know and understand. What products or services do you use every day? Those could be good starting points. And remember, you can always ask for help from a financial advisor. Section 7. Knowledge is power. Research before you leap. Before you buy any stock, do your homework. Read about the company, their financials, and what analysts are saying. Look for companies with a strong track record of growth and profitability. And don't believe everything you read online. Get your information from reputable sources. Remember, investing is not gambling, it's about owning a piece of a business. So treat it like a business decision. Would you buy a whole company without doing your research? Of course not. The same goes for buying stocks. Section 8. Patience, young grasshopper, investing for the long haul. The stock market is a marathon, not a sprint. Don't expect to get rich quick. Be patient and focus on the long term. Don't panic if the market takes a dip. Remember, what goes down often comes back up. Stay the course and let your investments grow over time. It's like planting a tree. You wouldn't dig it up every few days to see if it's growing, right? The same goes for your investments. Give them time to take root and grow. The power of compounding will work its magic over time. Section 9. Diversification. Don't put all your eggs in one basket. You've heard the saying, right? Don't put all your eggs in one basket. The same goes for investing. Diversification means spreading your money across different investments. This helps reduce your risk. If one investment does poorly, the others can cushion the blow. Think of it like a balanced diet. You wouldn't eat only pizza every day, would you? You need a variety of foods to stay healthy. Your investment portfolio should be the same. Diversify across different asset classes, industries, and geographies. Section 10. Risk and reward. Understanding the trade-off. In the stock market, there's always risk, but there's also the potential for reward. Generally, the higher the potential reward, the higher the risk. It's like climbing a mountain. The higher you climb, the more breathtaking the view, but also the greater the chance of falling. It's important to find the right balance of risk and reward for your investment goals. If you're young and have a long time horizon, you can afford to take on more risk, but if you're closer to retirement, you'll want to be more conservative. Section 11. The final word, keep learning and growing. Congratulations! You've just completed Stock Market 101, but this is just the beginning. The stock market is constantly changing. There's always something new to learn. So stay curious, keep learning, and never be afraid to ask questions. Remember, investing is a journey, not a destination. Enjoy the ride, and don't be afraid to make mistakes along the way. That's how you learn and grow as an investor. Now go out there and start building your financial future.